Ken Shinoda joining us right now, portfolio manager with DoubleLine Capital. And Ken, is not just the equity market showing extreme moves. We saw extreme moves in the bond market with the 2-year yield rising the most since at least October, and a 10-year yield having its biggest reaction to a Fed day in at least 4.5 years.
Yeah, I like to not look too much into the price action on Fed day because you have a lot of positioning going in and people have to unwind their hedges and their longs. But, the Fed did what the market was pricing in. The market was pricing in going in today almost 100% probability of a rate cut today, and then 2 more next year, 1 in the summer and 1 towards the end of the year. So it's kind of funny that you get such big moves when the market gets what it's priced in.
Right, Ken. So here's my big question. Do you buy the dip? My profound question.
Yeah, look, I think equities were very overvalued going into today. You've had a huge run. You saw breadth in the equity market start to deteriorate over the last couple of weeks. I saw strategists put out that it was the worst breadth in 11 trading days in the last 100 years yesterday morning, where most stocks were down and the Mag 7 was kind of holding the market up. So I'm not surprised we're seeing a correction in the equity markets. The bond market, we've seen this level before. In fact, we've seen worse than this. We saw 470 on the 10-year earlier this year. So we're just retesting the 450 level on the 10-year. It's a pretty critical point. We'll see if we get some buy the dip here. I think this does give investors a chance that want to add a little bit more interest rate risk or duration of the portfolio to take a bite of the apple here at this 450 area.
How contentious will the debate be in 2025? I mean, the first question in the press conference was, why cut today if there's such a cautious outlook for future rate cuts for elevated inflation? And Jay Powell admitted today was a closer call. That suggests that next year it's going to be, a raging debate.
I think there is just, as you say, there's a lot of unknowns, and they have wanted to normalize policy today. As he noted himself, they're 100 basis points closer to the neutral rate. They don't know exactly what the neutral rate is, but at least they've made this move this year. And by pushing back next year's cuts to the middle of next year and the end of next year, that gives them a lot of time to get data in to help decide how they need to proceed. So they've just given themselves optionality. And the market doesn't like that. The market doesn't like that uncertainty.
Martin certainly doesn't like that uncertainty, and you're seeing that reflected on the screen. Just for our viewers, stocks continue to hit session lows. Bitcoin down 5%. The VIX now above 22. And Ken, I pose this question back to you. When it comes to uncertainty and maybe the potential for volatility going forward, how much should we make of the lack of consensus around this meeting? I know we have to wait a few weeks to see the minutes here, but you're going into 2025 with policymakers clearly divided. That's clearly evident in the dot plot. No one seems to really know what the Fed should do next.
Yeah, I think a lot of it has to do with the change in the incoming administration. There's so much uncertainty around what they're going to do fiscally, what are they going to do with tariffs, what's that going to mean for inflation. So it's not surprising to see so much dissent between the members. But time is on their side now. Credit spreads have come in while equities are down today. They're clearly near all-time highs. So I think the credit markets have loosened up. Financial conditions that have improved. Companies can borrow. Even people in the real estate market can borrow again. So they're getting what they need for economic growth. They're just worried about a re-acceleration in inflation now.
So if that's the case, what do you do in the bond market and the long end in particular?
Yeah, we like being underweight the long end. I mean, maybe not right quite the second after this big sell-off. I wouldn't be selling into today's pressure, but the fiscal risks are out there. There's a lot of talk about what's the right term premium. Is there going to be more bond issuance in the future? So generally speaking, we don't really like ultra long end exposure. And when I say that, I mean things like 30-year treasuries. But you can still put together a very attractive intermediate term or shorter term bond portfolio. And with this rise in the base rate, you can buy some credit assets, put them together and get about a 6 to 7% yield. That's on par with long run equity returns. And that's positive real return after inflation expectations today.
Ken, based on what you heard today, what data point becomes the most important now going forward?
I think it's a mix. I think inflation is obviously going to continue to be important, but they're closely watching the job market. That's what they were most concerned about. They've been recently alleviated with stronger jobs report in November. So I think they had stopped really looking at inflation so much, thinking that they had won that battle, and really they just needed to save the labor market. But now I think both those two things have reared their heads back into their minds.
Ken Shinoda over at DoubleLine Capital, thanks to him, and we'll catch up with him again in the new year, I'm sure, as we parse the market reaction, guys, to that big Fed decision.